Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 8th of March 2020. And yesterday we published our Gold and Silver Weekly Update for the week ending the 6th of March. Also yesterday, our Richard and Greg channel published an update on the subject that dominates the news today. And we highlight how it is much more serious than the politicians and news media are actually making it out to be. Now today, we thought we would share a few thoughts with you before the financial markets open tomorrow, and some of the additional factors that could have an influence, which were not necessarily covered in any depth in yesterday's videos. Now firstly, Jeff Curry, Goldman Sachs head of global commodity research, published in the bank's latest report that the world is facing, quote, the largest commodity demand shock since the global financial crisis and sees more volatility ahead, unquote. And this to some extent can be seen in the oil markets, where crude prices have already fallen well over $13 a barrel in just the past 2 weeks. The oil situation is further exacerbated by Russia breaking the OPEC oil alliance on Friday, which people started to call OPEC Plus, when Saudi Arabia-led OPEC and Russia failed to agree on deeper production cuts in response to the economic downturn that has hit the global economy and its demand for oil. This means that oil prices may continue, almost definitely will continue to fall further. The oil market, arguably the most rigged commodity market in the world, as the result of price fixing by OPEC, may now find itself in a world of hurt, and especially the US shale industry, which may find it extremely difficult to compete at these lower prices because of its costs of extraction and production. In fact, on Saturday, Saudi Arabia slashed the official selling prices of its crude to the United States, Europe, and Asia by as much as $8 a barrel, according to the Financial Times. And this is after the reduction in prices we had already experienced the previous 2 weeks. And this, we suspect, is just the first salvo in what will become a most embittered economic battle over the supply and price of oil. The second area of consideration is the dramatic fall in bond yields, with US 10-year bonds yielding just 0.76%, the UK just 0.23%, and Europe minus 0.71%. And yet, of course, bond prices have risen and are currently much sought after. Why? Because interest rates are expected to fall further, thereby providing capital appreciation for existing held bonds. This is mopping up safe haven money that would normally be reserved for gold and, to a lesser extent, silver. Now, the European Central Bank is expected to loosen monetary policy this week when it meets on Thursday, with economists already slashing growth forecasts. The Fed, having reduced rates last Tuesday, has set the scene. And even though interest rates in the ECB are currently standing at minus 0.5%, and the central bank already has a balance sheet holding 2.6 trillion euros worth of bonds, Christine Lagarde will be under enormous pressure to ease even further. And after all being new into the job, she certainly will not wish to be seen to fail any additional economic downturn. Now on Wednesday, the UK's Chancellor of the Exchequer will be announcing his budget, which will be the first post-Brexit budget for the United Kingdom. And once again, we expect this to be a giveaway more than it collects in order to aid failing economic growth, to anticipate further cuts in domestic demand, and to fulfill general election spending promises. Under normal circumstances on the first budget of a government, it's traditional that they would be normally quite harsh, because they will know that they have 4 years or 5 years now ahead in order to correct that harshness and just prior to the next election become more free and liberal in order to attract votes. They cannot do it this time because the current Prime Minister has to sort out the Brexit fiasco before the end of this year. And we suspect that he is going to be very generous in this particular budget, unlike those of the past. Now, in addition to all of this, we've taken yet another look at the relationship between gold and silver. And to be blunt, we still see gold as the better investment for now. Now, we've reached out to a number of dealers, and frankly, they're telling us the same thing. But we accept we are in the United Kingdom, and gold is more favourable over here because of the VAT levied on silver, which does not apply to gold. But if the global economy continues to decline, the disparity in price between gold and silver is going to become even wider, and it's already at unprecedented levels now. However, what we all should note and watch out for carefully is that any sign that the economics improve, then you will see that gap reduce. But quite possibly, it will then be more to do with the gold price falling than the silver price rising. But we are some months away from that occurring. Now, we could be wrong, but there is still nowhere near the demand for gold at present, which is causing its price to move so much out of kilter with silver that investors then turn to silver as the more attractive option. Now, what we mean by that, it's a term people often hear called the blow-off top. What happens? The price of gold goes up and up and up, and silver naturally follows it, but often in a laggard situation, until gold then reaches that point at which it's then deemed too expensive. And then investors move into silver because it has lagged gold and is now seen as the better investment choice. And when that occurs, silver then outpaces any rise in the price of gold. And this is what the pumpers have been claiming is about to happen for the last 10 years. It does eventually occur, that is true. But the secret of all investment is time. Now we wish to talk about technicals, which we briefly touched on in the weekly update, but we've done some further analysis since then. Now, whilst we are expecting gold to rise again this week, and almost certainly in euro terms, and then later in the month in sterling terms, there is an alternative scenario that should not be entirely ignored. It goes like this. Whilst the broader market sentiment favours further upside in gold, the daily technical chart is calling for caution. Someone regarded Friday's candle, technical term, being a spinning top-like candle, which signals buyer's exhaustion. Now this, running alongside the bearish divergence of the 14-day relative strength index, or the RSI, suggests scope for a notable price pullback. You see, gold may be forming a double top, with the neckline support at $1,563. Acceptance below that level would confirm a breakdown or bearish reversal. Now, we're not convinced at all that this is going to happen, but as we saw a week last Friday, anything can happen, including equities eventually coming back into favour. So whilst short term, we're not 100% convinced this is going to be the case, let's at least accept it is a possibility, and one that technical traders, and especially day traders, will be very much aware of. And we all know that the paper markets are controlling the price right now. We would suggest, if this does occur, that it would be a wonderful buying opportunity to acquire more gold. Now, there's not a great deal more we wish to say at present, as markets will open soon, and the United Kingdom and then US markets some hours later. Nothing can be taken for granted, but as we mentioned on the Richard and Greg channel, we still believe that governments are underplaying the seriousness of the current economic and geopolitical positions. And in order to avoid any form of panic, they do this, and it is common practice. And it also enables them to buy time, hopefully to put corrective measures in place. The problem, as veterans all know, is that the world does not operate in a nice, logical and timely manner. And being caught out is, during these times of high volatility, more likely to happen than not. So let's all stay tuned this coming week for the ECB decision, and the following week for the FOMC, and the week after for the Bank of England decision. We suspect that March is going to be one heck of a month. Thank you so much for listening. If you haven't already done so, please subscribe to our channel. And once you've done this one, also the Richard and Greg channel. And press the bell sign so that you are notified of our videos as and when they are published. And we've placed all relevant links in the description box below. We hope you have found this video interesting and informative. And if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.